Hi everyone, welcome to the SMT TV channel. Okay, please like and subscribe to my channel and click the bell on the right side to get a notification as and when I have the latest video. Show me some love, please like, subscribe and click the bell video. See you inside the channel. Hi, today I'll talk a little bit about savings. Okay, there was answer one of the question of one of the viewers. He was asking, as a young person, and he has some, he can save up some money right now as he's young. Should he put the money in the bank or should he put money in an insurance company? Because some of the financial advisors are looking for them for putting in endowment policies or life insurance policies. Okay, let me share with you these things about savings. Okay, so the first thing, what I feel about saving is a cost. What do you mean by saving is a cost? Okay, understand, right? The purpose of putting money in a saving account is to provide what we call liquidity. Okay, is to provide liquidity in the market. Say for yourself. Let's say example right now, you have an emergency. Okay, suddenly you're out of job. Okay, that's why you can use this money as a bank and you can use it for liquidity. Okay, but if you put too much money in the bank account, okay, understand that bank accounts give you very low interest rate. For the purpose of liquidity, for the purpose of giving all the services like ATM and things like that, they give you very low interest. Yes or no? They give you very low interest. Okay? But because they give you high liquidity, they actually just give you very low interest. So my ballpark figure for saving is do not put too much money in your own saving account, in your bank account. Okay, so what you have to do is actually, my advice is to look for maybe around here 3 to 6 months of monthly income. Okay, let's say example, your income right now is $3,000. Okay, so 3 months monthly income will be about $9,000. Okay, 6 months will be multiplied by 6 months, 3 about $18,000. Okay, so this money is your goal. Put the money in your bank. Okay, so in the event you suddenly are out of job, okay, your 3 months saving can, maybe because you're out of job, you can lower your expenses. Your 3 months saving can last you maybe 6 months. Yes or no? Okay, and your 6 months saving can last you maybe double of that. Okay, so the purpose of having money in the bank is mainly to have liquidity. Okay, but if you put too much money in there, it becomes a cost. Why? Because this money can be used invest, okay, can use someone else to generate higher interest rate. So it doesn't mean that putting money in the bank is method. Okay, then the next question is, Colin, why do I put in the endowment policy or some kind of life insurance? Is that the answer? The short answer for that is actually no one. Okay, it doesn't mean that when you put money in an endowment policy or a life insurance policy is the right way to do. Okay, I've got 8 years in a financial advisory business and I did MDRT for a few years. Okay, let me share with you the reality of insurance company. So when you put the money in an insurance company, okay, in an insurance company over here, okay, who get paid? Okay, who get paid when you put the money in insurance company? The financial advisor get paid. Yes or no? The financial advisor get paid because you put a percentage of money in this insurance company. Okay, they can take as much as maybe 100% of your annual income. Let's say example, 1 year you put $100. 1 month you put $100, 1 year you put $1,200. Okay, the financial advisor can make between $1,200 to maybe double of that just by you committing $100 plan to the insurance company. The financial advisors can make from about $1,200 or more than that, to even 2 years of your annual income. So for the first few years, you put money there, right? The money actually doesn't go to you. The money goes to the person who sold you that policy. Okay. On top of that, okay, then you also need to pay the insurance company itself. The company itself need to get paid. Yes or no? Okay. The company need to run the business, to do advertising. All these need to get paid also. Yes or no? On top of that, okay, the financial advisor usually also have a manager. Yes or no? The manager also get paid percentage of what we call overriding from the financial advisor also. Yes or no? So you also get a percentage of the money that you pay to the insurance company. Then this question is, if I put this $100 a month, okay, in the company, this person make about 1 to 2 years of my annual premium. This person make a percentage. This person make a percentage. Then how does the insurance company make money? The answer is because you are committed to put this $100 for let's say the next 20 years. You follow what I'm saying? So they actually make money in the future. Okay, so for insurance company, they actually have what we call persistency. That the business must remain in the books for a certain number of years. So the conclusion is like that. When you put money in insurance company, a lot of money go elsewhere rather than goes to your saving account. It goes to elsewhere because you commit for the next 20 years. And at the end of the day, the returns over here, it can be maybe from maybe 3%, 3 to 5%. Okay, that is the returns if you were to put the money over the next 20 years. Okay, but if you were to put the money over just the next 2 years, and they say, no, I don't want to pay anymore, I want to stop the policy now, how much money I get back? You get back very, very little. Why? Because the money you just paid all the other people. Very little money goes to you. So in this example, even though you get higher returns, 3 to 5% compared to the bank, you have low liquidity because you cannot actually stop. You cannot actually take out the money. Yes or no? Okay. So in general, for me, right, I would not put my money in any endowment policy or life insurance policy for the purpose of savings.
So, if you don't want to miss another one of our trading video, remember to ring that bell.